Okay, we are a lot. Daycares were subsidizing that 36,000. They were charging everybody, or they weren't charging
Right.
36 for
Yeah.
infant care. They were subsidizing that
Right,
with the cost of 3 and 4-year-olds.
right.
We started this when we did the universal pre-K and paid half the tuition, half your regular student payment.
Yeah.
Yes. Oh, we weren't sure what to do with it.
I get it now. We'll usually bring up and we'll make sure.
Okay.
Sorry, senators, I don't think.
No, that's fine. Anyway, they were subsidizing that with the, and when they lost them to the school system, then they had to absorb more
Right,
of the 36.
yeah,
And we had dual, the Department of Ed and Agency of Human Services had different standards, and it was a mess.
right,
One of the suggestions I've heard floating around is we put all 4-year-olds in to the school system. That will have a cost there, it
Yeah.
will have, but we know that the dual half and half isn't working.
right.
I'm hoping the other place fills that out, but depending on what happens to 4-year-olds, yes. It's also been suggested that perhaps we could look at some form of paternity leave where you would, if it's gonna cost 36,000
Yeah,
and the state's gonna pay 36,000,
right,
maybe we could find a way to subsidize people one parent at a time. We could afford to stay home for X number of months.
I had Pat look at that number as just, I don't wanna put him on the spot if he doesn't feel like he's ready to stand by it, but per week, what it costs for the paid family.
Okay, well, he is
proposals or
coming in
childcare.
to talk to us about that.
Well, because Joyce had said, oh, it doesn't cost, like the math doesn't work, and I was like, okay, I'd really like to see that if we're just gonna say that, so maybe after these two
Well,
presentations.
yeah,
we can-
no, Pat is coming in,
Today at 3:00.
yes, I've got next week's agenda sitting in front of me.
But then, Joyce, we can ask him, but Joyce had said, like, I did this work to,
Okay.
and it
So
didn't
we are
make
getting,
sense.
Emily is
Yeah.
here, Kevin is here, okay. The first thing on the agenda is we are going over the DFR's housekeeping bill. I got our drafter who wanted me to know, we don't have the bill yet. It has traditionally been just housekeeping. It's a 45-page bill and very technical, so they're still drafting it. Some years it starts in the House, and we've frequently just gone through it, so when it gets here, we know what's in there. And then if we have any further questions once we get the bill, before we vote it out, we'll have time to delve deeper into the issues we wanted to delve into. So I think that is it. And Commissioner Gaffney, yeah, we're gonna keep you around for a few minutes and see if we can do a confirmation hearing. And not make you wait till the last 3 days of the session. Commissioners may be the only ones that get that privilege. But I don't know, I've got Emily first, but I don't know how you've got it laid out.
Yeah. I think I'll start for the record, Kevin Gaffney, Commissioner, Department of Financial Regulation. And I do have with me, and they'll introduce themselves, Emily Kosicki, Director of Policy, and Emily Brown, the Deputy Commissioner of Insurance. Yeah, I think, Madam Chair, I think you covered that at the high level. I'll say our goal today is to provide you, because of that, with a good overview of the bill and its components. It is known as a housekeeping bill, which typically are technical corrections or maybe adjustments to prior legislation where there's just some structural changes in statutory references and the like. But in this bill, I think we definitely have that, and we have a few policy items also included. So in our, and I think we have a document that, are we planning to share that? I think so.
Yes, I'm sending it to Jill right now.
Jill,
Okay. That's fine. So, and just at a more higher level, typically when we have the DFR housekeeping bill, there's a number of different tax we take, but typically the captive bill is not part of the housekeeping bill. It's a separate bill, and I think you're aware of that. And that's already making its way through the legislative process. And there's a lot of reasons for that. First of all, there's a kind of an infrastructure in captive insurance with Vermont. Vermont, for those of you that probably already know, after the VCIA day, that is one of the leaders in captive insurance. And so that infrastructure process really is very collaborative between the department, the VCIA. So we always typically pursue a separate captive bill, and we're doing that this year. There's also sometimes more substantive policy issues that we don't want to necessarily jam into the housekeeping bill. So the housekeeping bill is covering a few policy areas, but they're not quite as kind of substantive or meaty items. And if there are separate issues that we pursue, we'll do those with separate bills. Last year, for those of you that weren't on the committee last year, there were a number of model laws. Some of them were for accreditation purposes. Some were for covered agreement purposes to avoid any federal preemption. And so a number of changes were in last year's bill. You'll see at least one kind of residual carryover of that in a technical cleanup at this point. But that's generally the overarching goal of the housekeeping bill. I think the plan will be to let Emily Kosicki cover the technical items. And then perhaps before we go into have Emily Brown cover the policy items, I'll highlight those before Emily starts. So I think I'll hand it over to Emily Kosicki to cover the technical items. That I think there are 5 of those, and then there's 4 policy items. So I'll hand it over to Emily.
Good afternoon. Emily Kosicki, Director of DFR Policy for the record. And we did just transmit to Jill a memo that outlines all of these changes, and we apologize for the timing. But just to run through the technical changes, which again, we're not viewing as substantive changes, but just cleanup suggestions. One would be to correct a cross-reference in the credit for reinsurance law. As Commissioner Gaffney just referenced, this is related to a change that happened last year in Act 139. We had adopted amendments to existing credit for reinsurance law last year to come up to date with model language from the National Association of Insurance Commissioners, the NAIC. Many of you are likely familiar with model laws that come from that association that we work hard to keep up to date with. And so we did that last year, but found that in doing so, we missed some of those details in updating cross-references. So this would be the first cleanup item, is to fix a reference to a subsection that no longer exists.
You're posting it now. Okay, I just hit update and it didn't show. So wait a minute, and we'll post it. Yeah. So it will shortly be up on your iPads, computers.
And just while you're waiting for that to come up, the model law changes are, driven by either the desire to kind of move to a more substantive regulatory regime, but also they typically have accreditation they're part of accreditation requirements. So it's really critical that we get these, and we appreciate the work at the last legislative session, getting several model laws in place that were related to accreditation. And for those of you that don't know, accreditation basically means that as state-based insurance regulators and state-based insurance banking regulators, there are certain requirements that we have to meet so that other jurisdictions can know that they can rely on our ability to regulate the domestic insurers and the state chartered banks and credit unions. So accreditation happens every 5 years, and we are up for accreditation in 2026. But there's a lot of interim accreditation standards that happen along the way. So a number of these activities are to make sure that we're not only prepared for the next accreditation, but we're meeting the interim requirements.
Okay. So Emily, we're back to you, and it is posted. It is on the committee website for anyone that wants to read it. Okay.
The next would be another cleanup item from Act 139 of 2022. Again, that was last year's housekeeping bill, and Section 20 of that act adopted the Vermont Insurance Data Security Law, which was again based on a model from the NAIC. We adhered pretty closely to the model language from the NAIC, but there were a few deviations from the model language. And during the drafting process, some changes were made to the NAIC definition of a licensee that included some words that could have the unintended and undesired effect of excluding licensees that are domiciled from outside of Vermont from complying with our data security law. So we are hoping to make a tweak to the definition to remove that extra language and make clear that the requirements apply to companies that are located outside of Vermont or domiciled outside of Vermont.
Not seeing any questions.
Okay. The next would be to correct an error or inappropriate language around denial of a banking license. Existing law in Title 8 states that the commissioner shall return to an applicant for a banking license any amounts paid for the applicable bond requirement and license fee in the event of a denial. But we don't actually receive the premium. Any bond that we receive is issued by a bonding company, and we don't have the funds to return for any amount paid for the bond. So this would just be some suggested cleanup language to clarify that evidence of the bond can be returned and the license fee, but just removing reference to any amount paid for the bond requirement.
Okay.
We
We didn't receive any money for the bond, so we can't pay it back.
Correct. The next is to update the notification method for rescission of debt adjuster contracts. Existing law still refers to Telegram, and we'd like to update that to remove reference to Telegram as a method to provide notice of rescission and to add electronic mail for a possible delivery method.
Sure.
Okay, this is rescission of debt adjusters contracts. I just remember trying to get notification of cancellation of insurance policies done via email, and it got to be very controversial.
Mm.
This is another professional. Okay, Senator Brock.
The question is other methods that exist now, such as doing it by US mail. Is it required that there be a receipt for that, or is it just simply first-class mail?
I believe it is first class mail. Let me I may have to follow up with you on that, but my recollection, not having the statute right open in front of me, is that it is just first class mail.
Just the question as to whether or not there needs to be some ability to verify that the individual didn't or company did in fact receive the item.
Understood. And I'm just pulling up the language. It's currently to mail or deliver, to send a telegram. I'm not seeing right now a requirement for, receipt of delivery, but I can follow up on that question.
The real question is if the person or individual to whom this is sent says, I didn't get it, then what?
And that, I'm not sure that there's a method of recourse for cancellation of a debt adjuster contract based on receipt of the notice. But I'm going to have to follow up with our banking folks. It's just not an issue that I've heard come up a lot before, but I will look into that.
If we had more faith in our mail service 20 years ago than perhaps those of us that live in rural areas do now. There's no sleet storm or anything else prevents the mailman, so. Okay.
Okay.
We can keep going. We've got that one you're gonna look up.
Okay. And then the last that we have in the category of a more technical change is to codify an existing interpretation of a longstanding banking division interpretation of a rule that a lender can't require a deposit as a precondition of a loan except for certain defined circumstances under Vermont law. And the banking division has interpreted that to mean that any allowable deposit in those limited circumstances can't result in an effective interest rate that exceeds existing legal interest limits. So that's, in those circumstances where you can require a deposit as precondition of a loan, it can't result in an effective interest rate that exceeds our usury laws.
Okay. So if the interest on the loan would be $100, I can't tell you you've got to put in a $200 deposit in order to get the loan.
Correct.
Okay. I could perhaps tell you had to put in $100 deposit in order to secure the bank's interest in the loan. The bank's. Make sure the bank gets paid if you default on the loan.
Yeah, well, it would be limited to the legal interest rate set in 8 VSA 41A, which I don't, again, have pulled up in front of me, but, again, it would be requiring that you can't go above those legal interest limits for this type of circumstance.
Okay. Okay, I'm not seeing any questions. We can keep going.
Okay, thank you, Emily. I think what I'll do is maybe take each one of these policy items and just provide a high level and then let Emily get into them rather than try to describe all 4 at once. And then I think that will be a little more organized. So the first policy initiative, which is the 6th item on the memo, is confidentiality of property and casualty filings. So currently, proprietary information, particularly algorithms and proprietary models, are not held confidential under current law. And the challenge for regulators now, as we try to really look more closely at these models and not just look at them in a snapshot in time, but want to look at them over time as they get updated and changed, is to have more of this information in the filing that's filed by the insurance industry versus not. So it'll just give us more information to take a closer look at. There's a number of activities that are related to this. It's not just the complexity of filings, but there's work that I'm doing at the NEIC regarding artificial intelligence and machine learning, and all of these tools and algorithms are really needing to be looked at more closely by regulators, and this will give us the tool to do that. And at the same time, have a complete filing of the actual output of all the algorithms work in the filing for public inspection. But just allows us to look more closely behind the details of these more confidential models and algorithms. And I've probably got a little too detailed and stole some Emily's thunder, but I think Emily can provide kind of more of the day-to-day operational challenges we have right now in working around the current construct.
Great. Thank you, Kevin.
Okay. Emily, I think I got two Emilys.
You have two Emilys.
Emily Brown,
In
sorry.
county delegation last night, which had 3 Anns and an Andrew.
Wow.
And Emily's been under the weather, so she's soldiering on though.
Yeah,
Okay,
No.
well, hope you're feeling better. And
thank you. So for the record, Emily Brown, DFR. So as Kevin said, this is really just gives the department the ability to take a deeper dive into a lot of these rating models that are coming into the department, and to ensure again that they're, the components of them are not unfairly discriminatory and are in line with state law. And as it says in the memo, this would bring also the property and casualty rate filings in line with all the other rate filings and form filings the department received. So currently there's a process in place where if a company has a piece of information that they are determining that or they think is a trade secret, they can apply essentially or submit a request to the department for us to grant a trade secret status, and then under Title I, and then that is then, usually submitted to our legal team for an analysis, and then it's granted. So it's not a blanket, confidentiality that would be applied to these P&C property and casualty filings. It just allows them to have the right to say, okay, this piece of information is a trade secret, and we'd like for it to be kept confidential. So as Commissioner Gaffney said, this will just allow us to have those actually submitted to the department and recorded in our records, and give us the opportunity and our actuaries the opportunity to take a deeper dive and just ensure that everything is up to our statutory requirements.
so you're basically asking for more information from the insurance companies. Some of that may well be a trade secret or would disadvantage them if their competition got a hold of it. So you're asking to be able to get it to protect consumers, but you're asking us to not require that you reveal it in a public records request or post it on your website.
Exactly. Yeah. And the language, and I don't have it right in front of me, but essentially just adds, right now there's no kind of exception to the default of everything being a public record. So this just adds a few words to say, unless deemed, I think it says unless deemed trade secret or proprietary information. So it just gives the department that lever so that we can say, okay, we're not going to get this information unless we have the ability to deem it a trade secret. And so this just allows us to get that information.
Okay.
Yeah, I think the language says something to the effect of, instead of just saying all information is public, it's now all it would be all non-proprietary information would be public, so that we'd still have public access to all non-proprietary information.
Right. Yep.
Okay,
And you know, as I said, it really allows us over time, when there's changes to these models, to see the prior model and see what was changing and how. And I think that's really going to help us as regulators to really have a better surveillance of the use of these technologies and over time.
okay. I'm not seeing any questions, so we can move on.
And item 7 is an update basically to an approach that the department had already taken previously. And this is in the area of long-term care insurance. And the overarching goal here was to establish greater transparency and awareness on the part of the public and the part of policyholders when the insurance industry was making changes to the rates in the marketplace. So instead of the normal just filing it and having us review it, that there was a requirement that the insurance company would have to notify the consumer at the same time they were filing it with the department. And I think the goal was well intentioned. The challenge is that oftentimes when we review long-term care rate filings, there's a very extensive, as there are for all of our rate filings, review of those. And that review typically results in a substantially lesser increase. And I say increase and not decrease, because the reality is the long-term care market has some challenges on the solvency front. And so we are seeing rate increases, but those are reviewed and typically are, you know, I'm not going to say universally, but typically 50% of what was filed in many occasions. So what it's doing is creating, I think, much more angst for the consumer who gets the initial notice of what the company intended to receive and what is actually approved by the department. So what we were doing here is to provide a process to still have transparency, but that notice to the policyholder is of the approved amount and not the filed amount. Because I think what we've learned, and I've personally been on tens, if not hundreds of calls with consumers and our staff, is that what we don't want is consumers to make decisions about their policy based on what was filed and not what was approved. I would hate to see someone perhaps make a decision on information that isn't the ultimate outcome. So I hope I didn't get into too much detail there, Emily, but Emily Brown can kind of articulate kind of the details of why and the benefits of this change.
Yeah, no, I think you did a great job covering that. I think the only thing I would add is that we did, interact with industry on this change. And I think what we found out is that right now, even though the statute only requires a 45-day advance notice before a rate increase will go into effect, the industry standard by and large was 60 days. So this change is increasing it to 90 days. So it's really in effect adding 30 days to the notification period. So now consumers will have 3 months of time with the actual approved rate increase that they can make a decision whether to accept the rate increase, make changes to their policy, and then hopefully, be able to have a little bit more time to financially plan for any rate increase that could occur.
Okay, Emily, I'm visualizing the objections. Right now, I hear you're going to get 100% to my long-term care. And I can decide if I'm going to pay the next bill that comes in or it's not, or I'm going to cancel it tomorrow. So if you don't tell me that until after you've decided, and it turns out I'm only getting a 50% increase, but is the consumer losing something when the consumer gets that notice that a rate increase has been applied for, do they have any ability to input into the decision-making process, and are they losing that by our making this change?
No, they're not losing anything. And as Commissioner Gaffney said, when we put the bulletin in place, the intent was to try to give consumers as much notice as possible. And I would say on average, the review process, so from when a company files the rate increase to when we approve it, is around 6 months, I'd say. So when they're getting a letter 6 months in advance of a rate increase, but that might say 300%. And then what happens between the 6-month period is that we get a lot of panicked calls from people saying, I'm going to get a 300% rate increase. We want to avoid the situation where people are potentially making decisions off of a number that's not accurate, not taking away any ability of them to call the department, ask questions. Right now, there is no, it's not really similar to, for instance, major medical, where there's a hearing and a public process. There's not that standard for long-term care. But there is, an affordability standard, and there's an unfair discrimination standard, as well as a lot of actuarial standards that companies have to adhere to when they're making a rate increase filing. But this is not taking away any rights of consumers. This is really just trying to give them more accurate information at an earlier time. And as Commissioner Gaffney said, to save people from panicking and potentially making a decision on information that's not actually accurate when they're receiving it.
Okay, so.
And I'm sorry.
Yeah, I was just gonna say, so right now, if you're gonna make your decision based on, I assume, basically solvency. We want these rates to keep the insurance companies solvent. So, because if they go insolvent, then we've got, I don't know, we have the backup fund that we do for others. All right.
Yes, there's the Life and Health Guarantee Association, which is actually one of the updates that we're making, which we'll talk about next. But that is the backstop for long-term care. Okay,
but if I decide I'm canceling because I can't afford the 300% increase, I'm basically going to lose all the money I've already invested in it, right? I've been paying for 20 years. And I'm assuming once I cancel, I'm going to be starting from ground zero. If you only come in with 50% and I've got to go back, and now I'm 20 years older than when I started, I'm not going to get the benefit of those first 20 years of paying into the pool. I mean, is that what we're saying?
I'll let Emily think on that question, but I'll just say, I want to provide the committee with a kind of a fuller context of the process, because it's not just a review of a filing that has an outcome that's lower than what's filed, but there's also other components of that outcome. And usually those components usually give the consumer choice in terms of how that, what they want to do with that information. And what I mean by that is they can have the choice because some of the drivers behind what's caused the kind of pressures on insolvency are the escalating benefits that long-term care policies have built into them. And one of those escalating benefits is an inflation adjustment that really contemplated, when some of these products were developed, an inflationary environment that didn't exist the last 2 decades, save the last 18 months. And so some of those policies had benefits increasing at a 5% annual rate. Some of them compound. So the consumer has a choice at that time to trim the benefits, trim that amount, those benefits increase over time and keep that premium closer to what they were paying or much lower than the actual outcome of the approved rate. And I think there's also an option, and again, we're not the advisors to consumers, but what we have done is tried to educate. And I always say that part of our consumer protection arm is not just exercising the laws and regulations that we have jurisdiction over, but also educating consumers. And this is an area that we have done quite a bit. We've had town hall meetings on long-term care. We have recorded education pieces on long-term care insurance so that consumers have a fuller view, and so that when they go to make those options, they go to their insurance professional to help with those decisions. But certainly we provide some, not only education, but a process and a mechanism that gives them choice to mitigate the extent of the increase. Emily, you can feel free to add anything to that.
Yeah, I just wanted to actually ask for a little clarity around the question, because, and as Commissioner Gaffney was saying, usually when you receive, you're receiving your rate increase, they're saying, okay, our premiums are going to go up 100%. There's usually options within that letter that say, okay, you can, if you don't want to pay this rate increase, you can lower your inflation rate, or as Commissioner Gaffney said, you can reduce your daily benefit amount. You can increase your elimination period. There's also sometimes cash buyout options. And I think that goes to what you were saying, is that if you give it up, you're giving up everything. A lot of time there's an option that says if you stop paying, they're called either cash buyout, or there's also contingent non-forfeiture, which allow you to kind of retain, let's say you can't pay at all, allow you to retain some benefit even after, if you decide that you don't want to continue your policy. I don't know if that answers your question.
I think I'm probably still channeling Senator Sirotkin, who was the consumer advocate. But I can see that you don't want people making decisions based on what the company's asking for, which in all probability, if they make that, they're more likely, if you come in with a lower approved rate, to either cut back on their coverage or to cancel their insurance. You want them to make that decision once the rate has been agreed to. That I understand. My question, because what I'm going to hear, is what is the consumer giving up? And what you're saying is this isn't like a healthcare thing where you have the healthcare advocate and having 50 people come in and say, I can't pay that, is going to sway the decision, that your decision is really based on the data, what it's costing, the solvency, what the market is looking like in the solvency of the whole market. Because if the whole thing collapses, that guarantee fund is only going to go so far. So
right. I think I understand. I understand what you're saying, and so I'll just provide a little bit of a high level too on, there isn't a national, so the NAIC, the National Association of Insurance Commissioners, currently has a working group or a group of insurance regulators that are getting together to try to work on uniform methods of review, because what you'll find, and this is that while our statutory charge is company solvency, we also have an affordability charge, right? And so what that allows us to do is use different methodologies of reviewing rates that aren't necessarily the same way that a company or even another state might look at a rate. And when we're deciding on what method to use, and I think if you'd like, we could come in and talk to you about how we review these rates. We use a method called the if new method. And essentially what that does is doesn't allow the companies to look back. And it's a little bit more complicated than that, but it's a kind of looking forward methodology of the review, which we've decided takes into account or accounts for that affordability standard that we have to consider when we're reviewing rates. So it's not just about company solvency. It really, we do try to review rates and use methods and look at the rates with an eye towards fairness and affordability for the consumer. And especially with long-term care where you have a rate need that I think is very unique in insurance, right? We're not seeing a lot of other lines where these level of rate increases or rate requests are coming in. So there really is a lot of discussion within our department as well as with other states on what's fair, what's affordable, and then on top of that, how do we balance solvency when we're looking at this? Because we obviously want those companies to be around to pay these claims. So it's definitely more of a holistic approach, I think, than just looking at the science and just looking at the data. We really try to be mindful and keep in mind the impact to consumer. And an example of that is we've internally decided and have a standard that we apply that if a company is coming in for a rate increase that's less than 15%, let's say it's a 10%, we don't require them to spread that out, excuse me, over years. But if they're coming in with a 40% rate increase, we go to the company and say, okay, how are you going to implement this in a way that is going to actually give people time, if they want to stick with their current benefit structure, is going to give them time to acclimate to that rate increase so that they can actually afford it, right? Not a lot of people can handle a 40% rate increase on anything. So we've taken it upon ourselves to say, okay, even if it's justified, how are we going to implement this in a way that is affordable or fair to consumers who have been paying their premiums for, in many instances, tens of years.
Okay.
Yeah, that's a great illustration, Emily, of the detail. It isn't a blunt approval that is forced on consumers. There's not only options to control the actual amount of the increase, but options to pay that over time in trying to be sensitive to the affordability standard. So and there just are some overarching approaches that Vermont takes that I think are a little stronger on the consumer protection side in terms of what will allow to be approved in the filing.
Okay. Not seeing any questions, so I guess we can move on to 8, right?
Yes, and I think we started the segue there in the last conversation. So I'll let Emily kind of cover this one, and this is on the Guarantee Association Model Act.
Great, thank you. So the next change under number 8 is the changes to the National Association of Insurance. It's the Life and Health Guarantee Association Model Act. And this model that we currently have in statute has not been adequately updated. I think it's since the 70s. So we are implementing a lot of changes that maybe were made in the past years at the national level, at the model level, but then haven't been implemented in Vermont. So some of it is technical in nature, catching up, updating language to make sure our model is consistent with other states. Because something important about the Life and Health Guarantee Association is that while it's operated at the state level, it's a national system of guarantee associations. So it's important that all of the guarantee associations are treating policyholders in the same way, which I think makes these updates really important. But one thing that spurred the last update, which was in 2017, was the insolvency of long-term care insurer Penn Treaty. And so what what happened there is that a long-term care insurer went insolvent. Insureds, policyholders whose policies were covered by each state's respective guarantee associations then had to pay out claims. But what happened during that is the way that the original Life and Health Guarantee Association model was written is that all of the burden of long-term care insolvencies were actually put on health insurers. And if you look at the market today, most long-term care insurance is actually written by life insurers. So there was a compromise that was met between the life insurers and the health insurers to actually make a change to the model to split the liability of long-term care insurance insolvencies between life insurers who are members of the Guarantee Association and health insurers. And so that way there's actually a little bit more equity between who's actually writing the policies and the coverage and the member contributions that are required to cover these claims. Our language is coming in. I don't think it's finalized, but there are a lot of other changes that are being made that we'd be happy to walk through in detail. For instance, there's changes to the board composition that will be made, required changes to the association bylaws and how it operates, updates on who's actually covered and clarity around the types of policies that are covered. So there's a lot of good changes in there that I think are really important, will put us on even footing with, I think it's 35 other states that have already adopted these changes, and then make sure that our policyholders who are covered in Vermont are being covered in the same way as other states.
Okay. Any questions at this point? Okay, I'm back. I am not seeing any.
Okay.
Thank you, Emily. Yeah, and I think we note in the memo that 34 states have already adopted this model. So to Emily's point, I think we're wanting to kind of move this along and get that uniformity. The last item is the unmerged health insurance markets, and this was part of analysis that was led by DFR, but certainly very collaborative with a lot of other stakeholders. Emily actually was the lead on a lot of this work and a lot of the other work that we've done on the health insurance marketplace. It's not necessarily DFR's jurisdiction to determine the structure of health insurance, but to the extent we are the health insurance regulators, we were asked to kind of facilitate this analysis. So I'll hand that over to Emily.
Yeah, thank you. So I wasn't here, I think it was a few weeks ago, and discussing with DEVA about the results of our study and our recommendation to maintain the unmerged market structure till 2025. So essentially, this is just adding in that recommendation or that change to be in effect till 2025. One thing I do want to note, and it's kind of a timing issue, is that rates. So currently, the way the law stands is that the markets, if nothing happened this year, the markets would remerge for 2024. And so there is a little bit of a timing issue with this one, in that I believe issuers file their rates in May. And with the session going till June, I just wanted to flag this as something that while it's just the beginning of February, this one does have, I think, a timeliness aspect to it, where if it wasn't implemented before issuers were required to file their rates, there might be either confusion or uncertainty in the market. So I'm not sure what the solution to that is, but I just wanted to flag that one as I believe it was brought up to us by a House member as well.
Okay, we actually have that bill sitting on our board. I think it's one of three, and it's my intention, we'll get that out of here. I don't
Great.
This week, we'll get it out next week. We've already had the healthcare advocate and the well, our major insurer in. This seems to be one where there's no negative voices, so I think as soon as we can find 2 or 3 minutes free, we'll bring it up, get it up, we'll get it on the agenda, and get it out. Yes, we do know about rates. Those of us in health and welfare know about the timing with rates, and that to make changes in March to rates that are being filed is very difficult. So
Yes,
we'll get that one out and on the way.
Great. thank you.
Okay,
And that's it.
okay, that is good. As soon as our council gets through the 45 pages of technical language, we'll get that in, probably have you back. Seems like most of it is insurance, so if you want to bring us some more information on a couple of those, like the guarantee, bring it in, and we'll see if we can get this one out and on its way too.
I did have a follow-up piece of information on the question about the debt adjuster notification contract. This is language that would be put in a form that debt adjusters are required to give to the contract holders for how they can cancel the contract. So this would be, somebody who contracts with a debt adjuster, if the consumer wants to cancel the contract, they can provide notice. This change would allow them to do so by electronic mail or regular mail. It's not the situation of the debt adjuster canceling the contract.
Okay.
Thank you, Emily, and that's an important clarification, because we certainly wouldn't want to create barriers for a consumer to be able to do that without difficulty.
Okay, so I'm not seeing any questions at this point. We will we'll get that bill as soon as we do, let you know, and get it on its way at this point, unless something crops up. And I think, Commissioner, we're going to ask you to stay and talk to us a little bit about your background. I don't know if you want your coworkers to stay or you want them to go away.
I think they have plenty to work on, so I can let them go.
Okay, and we will keep you here for hopefully not too many more minutes.
But they can stay if they want.
And we will
Thank
give
you.
you the floor. There we go. All right, everybody is pushing, and you've just gotten much larger on our screen.
Oh, well, that's been a challenge
Yes.
through COVID.
But I've known you for years. You've been around in the department, and you came in as interim and now as commissioner. But we've got new people on the committee. So give us a little bit about your background. And I guess first, do you really want this job?
Well, I think it's finally getting the hang of it. So if I can keep it, that would be great. No, I'm very honored to have the opportunity to serve Vermonters, and really, I really mean that. But as much an honor to work with such a strong team as you just met, Emily and others. Yeah, I've been with the department. I can't believe it. It's 16 years last month now. I was in the insurance industry for 23 years prior to coming to the department. I worked for a company that, gave me an opportunity to move to Vermont. I worked in Vermont with this company since the late 80s. So I got to all corners of the state, and then had the opportunity to actually have a career up here, and really never looked back, and was very happy that I was able to land here. But as happens with the industry, with insurance and other industries, there's a contraction, and So the operations were contracted back to Pennsylvania, and Vermont was home at that point with 3 children in high school and 1 in college. So I think I added a child. I meant two in high school, 1 in college. But I came to the insurance division and worked through the ranks. I've been in almost every area. I haven't been directly in consumer services, but as I said, with the long-term care stuff, I certainly know that team and have worked shoulder to shoulder with them. I've been in the policy review area. I've been in the market conduct area, the licensing of individuals and producers. And I was appointed deputy commissioner March of 2019. And as you said, became interim in May of last year and was appointed in early July of last year. So I come to the department with a lot of industry background, and I thought that background would be helpful in this role. And I do see over time, as being a regulator over time, that there's definitely a combination of skills that make an effective department. I think having a knowledge of the marketplace is key, but having strong attorneys and policy people is also key, and also having strong financial and investigation folks. And we have all that at the department. So I think we often play off each other with our experiences to hopefully be the most effective regulators we can be. I think we want to recognize the challenge of the mission in front of us, which is to make sure we're always mindful of protecting consumers. But as you stated earlier, Madam Chair, we do have to have markets available for those consumers. That is a way we do protect them. So there is the balance of solvency and consumer protection. I don't see those as opposing missions. They're just missions that we have to be mindful of. We have to realize that markets and the availability of efficient markets can serve consumers well. And if we don't monitor and regulate those markets effectively, then those markets can become less efficient and more costly over time. In Vermont, we've, I think, experienced examples in the long-term care of market challenges, but we've also experienced very competitive and one of the strongest personal insurance markets in the country. You know, one of the lowest auto insurance and homeowners insurance rates in the country. And I think that's a byproduct of fair regulation, of fair kind of statutory convention of how insurance products come to market and are effectively regulated. And so, you know, we're blessed to have not only a very strong, and I'm very proud to have a very strong domestic presence of domestic insurance companies, and also a strong presence of state-based, chartered banks and credit unions, and a very strong presence of professionals that work in the securities industry and serve Vermonters and investors in that capacity. And of course, one of the leaders globally in captive insurance. So the department has a number of roles and challenges that we are tackle on a daily basis. I would say, as I look to the future, I see that the one of the items we covered in the housekeeping bill on looking at more detailed models and having more evaluation of those is an example of one of the challenges that we have to keep up with, which is we have to keep pace with innovation and technology that's happening in the marketplace, in whether it's in banking, securities, or insurance. So our process and our ability to stay aware of what's happening in the marketplace is critical. Our staying abreast of that information and becoming more knowledgeable in those areas is going to be critical. I think the I think the skill sets of regulators in the future are going to change over time. I came to the department as someone with a product development and underwriting and compliance background. I think all of those are important, but I think we may need, data analysts, and we may need more folks that deal with big data than we have currently on staff. We luckily have, we participate in a national association, and that gives us a lot of tools and access to tools and review methods to stay abreast of things without having necessarily the staff on board. But I do see that our ability to adapt and to have the right skill sets is going to be critical in the future. That being said, in the near term, it's challenging right now, workforce-wise, to attract new folks. It fortunately hasn't been as challenging to retain. So we have strong retention at DFR. Those of you that don't know, the department has one of the strongest engagement survey results. We also did a lot of other surveys as COVID hit us in 2020 and again in 2021. We surveyed our staff to just check in to make sure that this hybrid work environment is working, what's not working, and what we can do better to make sure we have that cohesiveness that you need with a combination of doing virtual work and also having in-person engagement. And really, when I think about that, it's not just about the team and making sure everyone's on board with the mission, but it's developing new people that do come to the department and making sure they're assimilated to the department. So we're continuing to look at different ways there to do that better. There's certainly a number of other challenges on the horizon. We're monitoring the ongoing developments of private equity investment in various markets, and what that means. On its surface, it could mean opportunities for greater choice and more efficiencies in the marketplace, but we also have to look at what it may mean for changes in mission of that organization and solvency. So we're always looking at that. We're not looking at it with the same instruments we've looked at in the past. We may have to look at things a little differently to assess those risks and assess them, based on their current construction. So my approach to things is I try to be very accessible. Like I said, I've been on tens, if not hundreds of calls with Vermont consumers. And I've always found that is really kind of grounds you in kind of what your purpose is, because you listen to them and you hear their concerns, and it just really helps us to know how better to serve them in the future. I
have originated some of those calls.
You may. You may have.
Oh, I have.
But I think that's one of the things I'm very proud of a number of things, but is that I think we're very responsive. We do get reach outs from senators and representatives on constituent concerns, and I think our team really thrives in that space. They look to solve those problems, and then learn from what the problem was and whether there's something new that we have to do to avoid those problems in the future. So it's not just addressing an issue, but identifying trends and trying to see what we can do differently to be more proactive and avoid those trends.
Okay. Committee, any questions? Thank you, Commissioner. We will get this out for a vote, and we will get it up and be on the floor. If you could send over a bio just to Jill, then I'll have something to present on the floor, and that would be very helpful.
Great.
Okay.
we'll do.
We have a question.
The big picture question, since you've been in the business for a long time. So every year we lament healthcare costs going up in double digits and always say we can only bear this for another year or two before things collapse, but we keep on going at that rate. I'm just wondering if you see anything on the horizon that suggests to you that we're going to bend that curve in a meaningful way.
Well, I think I don't see anything specific. I do see that the need to do that. I think costs will go up, particularly if there's no kind of structural change. So I think there probably needs to be ways to look at more efficient ways to deliver healthcare. And I know the AHS and we and DFR are just collaborating on the delivery of healthcare, and as well as a number of parties, both within state government and within the health insurance marketplace. It's not a simple issue. It's a challenging issue, but it's one that can't be just focused on the outcome of rates, but it has to look at the underlying drivers of cost. And so I think that's where the the focus needs to be, to have the opportunity to bend the curve. It can't solely be just on a rate review process. It has to be the underlying drivers of the costs.
Okay. Any other questions? Okay, thank you. Thank you, Commissioner.
Thank you, committee.
Thank you. We are ahead of time. Okay. I think I will put off a vote. I usually put off a vote for 24 hours, but we can put it in tomorrow, just in case there's somebody out there who has something awful to say. Give them a chance to let us know if there's some skeleton that we don't know about. But I'm anticipating we will.
No skeletons. Yeah.
Confirm the commissioner, and hopefully we will have a thing. Let's see. Okay, Damien and Pat can come in sooner than 3:15. So why don't we take a break until 3, and we'll see if they can come in at 3. And